Stashaway is the first robo-advisor to be awarded a capital market services license for digital investment management by the Securities Commission. It's the internet's alternative to overpriced, inconvenient and one-size-fits-all unit trust and investment-linked policies. Let's see what its Malaysia head, Wong Wai Ken, has to say about it. Okay, Wai Ken.
Hi, John.
Good stuff. Introduce the platform, man. What is it and how does it work?
First of all, thanks for having me on. Basically, Stashaway is Malaysia's first SC licensed robo-advisor. As a robo-advisor, we basically allow anyone to invest in lower costs, a lot more conveniently, with an intelligent platform.
So, regulatory hurdles, how many hoops did you have to fall through and jump through? You're the first licensed provider under SC.
Correct. We are the first and currently the only licensed robo-advisor. And it took us almost a year to talk to the SC and progressively gain their trust for us to ultimately be licensed. We were licensed in October of last year, and since then, growth has been really, really encouraging.
Okay. What did the SC want most from you before they gave you the license?
I think the SC wanted to see that there were operational and compliance structures in place. They wanted to make sure the people that were leading the charge in Malaysia were qualified. And also they wanted to make sure that investor protection was at the core of our product. So those were the main three things.
What about costs and what about returns? How important are those things?
Oh, it's really important because they're so related to each other. As a low-cost platform offering a really intelligent solution, our costs range from 0.8% per year, management fees. We actually don't have any sales charges, no switching, no exit charges. So that's our only source of income. So because of that, basically, users get to invest more of their money as opposed to traditional unit trusts out there. So when it comes to returns, we've done some extensive backtesting through different economic cycles and also through different crises like the 2008 crisis. And the conservative portfolios range from 5% returns to the most risky ones, which give you about 11 to 12% returns.
To get 0.2% management fee every year, how much must they have with you?
So it starts with 0.8, that's up to 50K. Progressively goes to 0.2 for balances 3 million and above.
Ringgit?
Ringgit, that's right.
So how many users so far?
We serve a few thousand users. Actually, it's been really, really encouraging because we've only been up and running for about 3 months. So I think the education process has been great. We've been featured very heavily in the press and we're very, very happy with the support that we've been getting.
Yeah, tons of robos coming on the market. Is it a boon or a bane to be the first mover?
I think it's the same side of the coin. The plus is that we get to set very high standards. And then anyone else that comes needs to meet or surpass those standards. On the flip side, there's a lot of education to be done. So we actually do weekly seminars for free to the public. And these seminars include things like personal finance goals that they have, introduction to investing, and how our platform works. All of this is done for free.
Okay, so you say it's intelligent, right? How intelligent is intelligent? How much of your funding has gone towards the algo?
So we spent about a year developing the product before we launched it. And when I say intelligent, it actually means that we have an investment framework and your portfolio that you have is not static. It's dynamic through different economic cycles. The investment framework takes in macroeconomic data and adjusts asset allocation as you go through different cycles. So
but only when cycles turn. So how do you, at what point in the cycle do you know that you've got to rebalance?
Yeah, so the economic indicators that we get from official sources based on fundamentals will tell us what economic regime we're in. So for example, in good times, you obviously want more exposure to tech, more cyclical sectors. And then in bad times, you want inflation protection, you want more gold, you want more fixed income. So the switching and the asset allocation is done automatically for you, and it's done free of cost.
So right now, you are mostly feeding into ETFs in the Western markets, right?
Absolutely. Okay. Listed in the US.
Listed in the US. The BlackRocks, the Vanguards of this
world?
world?
The State Streets of the world,
The State Streets, okay. Yeah. So your revenue stream of 0.8% at the bottom is really, that's the sole revenue stream you have?
Yeah, that's right.
Okay. Any onshore products? Any Malaysia products?
As a Singapore HQ company, our first expansion into Malaysia means that we really care about this market. So we want to have ringgit-denominated products to ultimately serve the market here. So we're working with different product providers and fund managers to see if there's a solution for ringgit-denominated funds.
Okay, well, there's a lot of people that think that ETFs have been getting too much inflow of funds and there can be outsurges sooner than later. What does that do for the model for you?
So if you take a step back, I think ETFs as a passive vehicle still are very, very far to go. I think it's only about 20 to 25% of total wealth that's being managed. There's a lot of active money out there. So we've definitely not really reached a saturation point yet. And the ETFs that we've selected are actually based on plain vanilla underlying securities. They're backed by real assets. No funky things like inverse or leveraged or synthetic ETFs. So we are picking ETFs that are liquid, cheap, and can track the index very well and have a long-term track record.
Are you always going to be passive, or would you do active eventually?
The best thing about us is that we combine the best of both. So when times are good and times are stable, we are a passive, the portfolio is relatively passive. But when there are inflection points where we go from one...
So you're active within the passive space, is that right?
Yeah, I'd say so. So okay. At the inflection points, we are active.
It will always be a passive space that you're in. You will never put into an alpha fund, is that right?
We're not closing the door, but I think our core portfolios are definitely constructed using passive securities.